studying your last two. I swim med when they turned in. The staring down to mute. And can learn the pole that sunk he died.
Every corporation that is required to file a T2 corporate tax return must do so within 6 months after the end of its fiscal year. This is one of the most important deadlines in Canadian corporate taxation, and every tax preparer should know this rule. Unlike individuals, corporations do not all have the same year-end. Each corporation chooses a fiscal year-end that best suits its business, and the filing deadline is calculated based on that date. The process is straightforward. Once the corporation's fiscal year ends, you simply count forward 6 calendar months to determine the filing deadline. For example, if a corporation's fiscal year ends on December 31st, its T2 return must generally be filed by June 30th of the following year. If the fiscal year ends on March 31st, the filing deadline becomes September 30th. Likewise, a June 30th year-end results in a December 31st filing deadline, while a September 30th year-end leads to a March 31st filing deadline of the following year. This 6-month filing rule applies to virtually all corporations that are required to file a T2 return. Whether it is a Canadian-controlled private corporation, a large corporation, an inactive corporation, or even many non-profit corporations that are required to file, the basic filing deadline remains the same 6 months after the fiscal year end. One important concept to remember is that the filing deadline is based on the corporation's fiscal year, not the calendar year. Many beginners mistakenly assume that every corporation files its tax return on June 30th or December 31st. But this is not correct, since corporations can have different fiscal year-end dates. Every corporation may have a different filing deadline. As a tax preparer, it is essential to track each client's fiscal year-end carefully, using tax software, calendars, and filing reminders can help ensure that returns are completed and submitted well before the deadline. Filing on time not only keeps the corporation compliant with CRA requirements, but also helps avoid unnecessary late filing penalties and administrative issues. The key takeaway from this slide is simple. Identify the corporation's fiscal year end first. Count forward 6 months. And that becomes the T2 corporate tax return filing deadline. Remembering this single rule will help you determine the correct filing deadline for virtually every corporation you prepare a return for. Calculating the T2 corporate tax return filing deadline is actually very simple once you know the basic rule. Start with the corporation's fiscal year end and then count forward exactly 6 calendar months. The date you arrive at is generally the filing deadline for the T2 return. This simple calculation works for virtually every corporation in Canada. Let's look at a few examples. If a corporation's fiscal year ends on December 31st, simply add 6 months, and the filing deadline becomes June 30th of the following year. If the fiscal year ends on March 31st, the filing deadline is September 30th. A corporation with a June 30th year end must file its return by December 31st, while a September 30th fiscal year end results in a filing deadline of March 31st of the following year. No matter when the fiscal year ends, the process remains exactly the same, just count forward 6 calendar months. A useful way to remember this is to follow a simple 4-step process. First, identify the corporation's fiscal year end. Second, count forward 6 calendar months. Third, determine the resulting filing deadline. Finally, ensure that the T2 return is completed and submitted before that deadline. Following this straightforward process makes it easy to calculate filing dates accurately for any corporation. Although the calculation itself is simple, missing the filing deadline can have serious consequences. If a corporation files its T2 return late, the Canada Revenue Agency may charge late filing penalties. In addition, if there is any unpaid tax balance, interest will continue to accumulate until the amount is paid in full. These costs can increase quickly, making timely filing extremely important. As a best practice, professional tax preparers should never wait until the last possible day to file a return. Maintaining a calendar of client fiscal year ends, using tax software reminders, and preparing returns well in advance of the deadline can help avoid unnecessary stress and costly penalties. The key takeaway is that calculating the filing deadline requires only one simple formula: fiscal year end plus 6 calendar months. By applying this rule consistently and filing before the deadline, corporations can remain compliant with CRA requirements while avoiding unnecessary penalties and interest. One of the most common mistakes made by new tax preparers is assuming that the T2 filing deadline and the corporate tax payment deadline are the same. In reality, they are two completely separate deadlines, and understanding the difference is essential for proper corporate tax compliance. The filing deadline determines when the corporation must submit its completed T2 corporate tax return to the Canada Revenue Agency. As we've already learned, this deadline is generally 6 months after the corporation's fiscal year end. Filing the return on time helps the corporation avoid late filing penalties and ensures that it remains compliant with CRA reporting requirements. The payment deadline, however, is different. It determines when any corporate income tax owing must be paid to the CRA. For most corporations, the balance of tax is generally due within 2 months after the fiscal year end. Certain Canadian-controlled private corporations that meet specific CRA conditions may qualify for an extended payment deadline of 3 months. This means that in many cases, the corporation must pay its taxes several months before the actual T2 return filing deadline. Because these two deadlines serve different purposes, they also have different consequences. Filing the return late may result in late filing penalties, while paying the tax late can lead to interest charges on the unpaid balance. A corporation could file its return on time, but still owe interest if the tax was paid late. Likewise, a corporation could pay the tax on time, but still face penalties if the T2 return itself is filed after the 6-month deadline. There are several common mistakes that beginners should avoid. Many people assume that every corporation has a December 31st year end, but corporations can choose different fiscal year ends. Others confuse the filing deadline with the payment deadline or forget to verify the corporation's fiscal year end before calculating important dates. Waiting until the last day to prepare the return also increases the risk of errors and missed deadlines. Another misconception is that inactive corporations do not need to file a T2 return, when in many cases they are still required to do so. The key takeaway is simple. Always remember that filing the T2 return and paying the corporate tax are two separate obligations with different deadlines. Track both dates carefully, monitor each client's fiscal year end, and plan well in advance. By understanding this distinction, tax preparers can help corporations avoid unnecessary penalties, interest charges, and compliance problems while providing a more professional and reliable service.